Most people think great stocks are the ones making headlines, but history shows the opposite. The biggest wealth is often created by buying strong businesses when sentiment is weak. Today, I'll talk about 3 stocks that are currently down or ignored, not because the businesses are dead, but because the market is impatient. This is not about quick money. This is about long-term probability. Let's start with the first one. Stocks on PayPal. PayPal is a classic example of a stock the market fell out of love with. A few years ago, PayPal was seen as the future of online payments. Then, growth slowed. Competition increased, and investors panicked. The stock dropped hard. But here's what actually happened. PayPal didn't stop generating revenue. It didn't lose its global presence. It didn't become irrelevant overnight. What changed was expectations. The market expected explosive growth forever. And when that didn't happen, the stock was punished. AI analysis focuses on something different. PayPal still processes billions of dollars in transactions. It still has a massive installed user base. And the world is still moving toward cashless payments. Is PayPal guaranteed to explode? No. But when a profitable company is priced like it's finished, long-term investors start paying attention. This is not a hype stock. It's a patient stock. Stock #2 SoFi Technologies. SoFi represents a very different type of opportunity. This is a bet on how the next generation handles money. SoFi combines banking, investing, credit cards, and loans all inside one app. So why is the stock still down? Because growth companies go through uncomfortable phases. Profitability takes time. Interest rate changes create uncertainty. And the market hates uncertainty. But AI models look at behavior, not emotions. SoFi's users are younger, digital native, and growing steadily. Once someone uses a single app as their main financial hub, switching becomes inconvenient. That creates something extremely valuable: retention. If SoFi survives long enough to scale profitably, the upside can be significant. This is not a safe stock. This is a high-risk, long-term growth bet. And historically, this is exactly how asymmetric returns are created. Stock #3 Palantir Technologies. Palantir is probably the most misunderstood company on this list. For years, investors complained, too complex, too dependent on government contracts, too expensive. As a result, the stock collapsed. But while the market argued, Palantir kept building. Palantir operates at the intersection of data, AI, and decision-making. Governments use it to analyze massive datasets. Companies use it to optimize operations and strategy. Once Palantir software is integrated into an organization, it's extremely difficult to replace. AI systems are only as powerful as the data behind them, and Palantir specializes in turning messy data into actionable intelligence. This is not a consumer app. This is deep infrastructure software, and infrastructure companies often take time. But when they work, they become very sticky. Palantir is not exciting in the short term, but long term, it's exactly the kind of company AI keeps flagging. Let's be honest, not all 3 of these stocks will succeed. Some may underperform. That's why smart investors invest slowly, diversify, and think in years, not months. Wealth is rarely built by following comfort. It's built by understanding what others are ignoring. If you want calm, long-term, AI-powered thinking about money, subscribe for more. See you in the next video.